Welcome back to Fair Fade Investing. Today we're going to be discussing Amazon stock, ticker symbol AMZN. We see right away price $151.94 and current market cap of $1.57 trillion. Moving on to the financial strength here. Main thing I'm looking for, cash to debt, just exposure to risk. We see here they have 47 cents for every dollar of debt. And with the trend line here, we see their cash to debt is actually decreasing versus history. Almost the lowest they've had in the last 10 years. Their median's around 1, which is preferable. If they had $1 for every dollar of debt, then they would have enough to pay down the entirety of their debt right now, but it looks like they have less than 50 cents. So they have twice as much debt as they have cash. On to profitability. We see right away fairly stable gross margins, and the gross margins represent the money a business makes after removing the direct cost of goods. Versus history, these are actually the highest they've had in the last 10 years. We see median of 11.7 and the maximum 15.19, which is where they're at now. Operating margins are the profit after the cost of goods sold, including expenses like rent or utilities. And we see versus the industry, right about the average. And versus history, they're on the upper end, but not as good as they have been in the past. Net margins increasing and then falling off here in the end. Net margins represent the total profit after all expenses. Free cash flow margins, which represent the percent of revenue that is left for expansion, dividends, or reducing debts after other expenses. We see here fairly stable and then a drop off. It looks like they're sitting right around the median for the industry. Versus history, this is less than their median. All of these margins represent business strength, but moving on to the management strength, we see the return on equity, return on assets, return on investor capital, and return on capital. It looks fairly strong, and then in the most recent, it drops off for each one of these. Nothing too outstanding versus history. We see yellow bars, green bars, nothing solid green like this one. So they're not doing the best they've done. Looking down at PE ratio, 78.73 is the current, fairly high PE versus the industry. This is on the very high end, in the 90th percentile of 738 companies in a similar industry. This company has a lot of growth priced in based on that PE ratio. Versus history, it looks like their median is 120. Their minimum is 43.9. So always carrying a pretty hefty PE ratio with a lot of growth priced in. It is lower than the median, but still fairly high PE ratio. Looking at the trailing 12-month revenue, there's $554 billion of revenue with a 1.57 trillion market cap. So just about 3 times their revenue is their market cap. That's a substantial amount of revenue, but if we look back at what they're actually generating for free cash flow, it's only about 3% of that 500 billion. So very cash intensive business it looks like at the moment. Looking at revenue over time, we see revenue steadily increasing. Cash to debt was growing in a pretty linear pace. 2021 rolled around, and then you see debt outpacing cash, and it's fairly steady now. But still, something that you don't necessarily want to see on the balance sheet is twice as much debt as you have cash, especially when interest rates are rising and debt is becoming more expensive. We see a little bit of falling apart here in free cash flow and the net income ever since 2020. If we look at shares outstanding, they were buying back shares in 2012, and then since then they've been selling more shares, which is also another bad sign. But it looks like they've stopped that now in 2023. But nonetheless, a lot of share selling, which dilutes shareholder value. To get a more accurate assessment of what this company could be worth and what's currently priced in terms of growth, we're going to have to run a DCF. So looking at the DCF, we see right away 10 years, there's no earnings per share data, 5 years and 3 years. The 5-year earnings per share growth is 27%, 3-year average annual rate for earnings per share growth is negative 4%. On the free cash flow basis, they have no data for the 10-year, 5-year, and 3-year. So that means we're not going to be able to run a free cash flow. We're going to have to use earnings per share for this analysis. So seeing what's currently priced in, there's about 31% growth currently priced in for the next 10 years on an annual basis. Over the last 5 years, we've seen 27% growth on average. So it's possible, but it's not quite likely unless there's some serious improvements in the business financials. The odds of a company growing at 30% annually for 10 years is fairly unlikely. So it's probably more realistic that it could grow at, even if we base our judgment off of the 5-year, then 27% means it's a negative 30% margin of safety. So fair value would be closer to 116 rather than 151. And even then, that's a lot of growth priced in. Maybe if Jeff Bezos comes back and he's investing in all these robotics and warehouse technology and drones, and who knows, the future could hold some very interesting things for Amazon. And they could revitalize their growth. They could expand into new industries, more profitable ways. But right now it does look like with 31% growth priced in, the odds are not in their favor of huge upside, at least in the short term. But all in all, this is my theoretical framework and assessment of Amazon stock, AMZN. Leave a comment below if you have a question or want a company reviewed. If you enjoyed the video, please leave a like and subscribe.